Welcome to Cashflow Positive, your go-to YouTube channel for financial insights and market trends. We're here to navigate the complex world of finance, breaking it down into bite-sized, digestible pieces. Our mission is to arm you with expert analysis and a data-driven approach, helping to turn financial jargon into language that speaks to you. Today, we're peeling back the layers on a pressing topic: why a market correction may be unavoidable at this point. Before we dive into the reasons, let's first understand what a market correction is. A market correction is a phenomenon that occurs when share prices fall by at least 10% from their most recent peak. This decline is generally a sharp and rapid one, over a short period of time. Now, don't confuse this with a market crash. While a crash is a sudden and very sharp drop in stock prices, a correction is more of a moderate fall. Think of a market correction as a reset, a breather for the market. It's like a marathon runner slowing down to catch their breath after a sprint. The market, like our runner, can't always be sprinting. It needs to slow down, to correct, before it can pick up the pace again. Now, why does this happen? Well, it's a part of the normal cycle in the financial markets. Markets can sometimes overheat, with prices climbing too high, too quickly. These inflated prices don't reflect the true value of the stocks, leading to an imbalance. Market corrections are a way for the markets to restore balance, to align prices with their true values. So market corrections aren't necessarily a bad thing. They can provide buying opportunities for investors, and can also serve as a reality check, reminding us that what goes up must come down. Now that we have a grasp on what a market correction is, let's delve into why one might be imminent. To understand why a correction might be on the horizon, we need to look at the current state of the market. We're currently in a market that's been described by many as frothy. The bullish sentiment is palpable, with investors displaying an almost insatiable appetite for risk. Indeed, market valuations are soaring, with price-to-earnings ratios reaching levels that would have been unthinkable just a few years ago. The S&P 500, for instance, is trading at nearly 35 times earnings. That's a level we haven't seen since the dot-com bubble of the late 90s. And we all remember how that ended. Meanwhile, the tech-heavy Nasdaq is trading at even loftier valuations, with a price-to-earnings ratio of over 45. What's driving these high valuations? Well, there are a few factors at play. Firstly, we have historically low interest rates. This has made borrowing cheap, encouraging companies to take on debt and investors to take on risk. Secondly, we have the continued growth of the tech sector. Companies like Amazon and Apple are generating enormous profits, and their stock prices have soared accordingly. However, these high valuations are not without their risks. When prices are this inflated, it doesn't take much to trigger a sell-off. A minor piece of bad news, a slightly disappointing earnings report, or even just a shift in investor sentiment can send prices tumbling. Furthermore, while the tech sector has been a major driver of market growth, it's also a potential source of vulnerability. Many tech companies are highly dependent on a small number of key products or services. If these were to falter, it could have a significant impact on their stock prices. And then there's the issue of investor sentiment. Right now, investors are optimistic, perhaps overly so, but sentiment can change quickly. All it takes is a bit of uncertainty or a hint of bad news, and that optimism can swiftly turn to pessimism. Given these conditions, it's clear that the market is ripe for a correction. History has shown us that periods of prolonged bullishness often precede market corrections. This is not a novel concept, nor is it a prophecy of doom. It's simply a pattern observed across decades of market activity. Let's take a trip down memory lane. The Roaring Twenties, a decade of economic boom and prosperity, were abruptly halted by the infamous Wall Street crash in 1929. This was a period of exuberant bullishness that led to a devastating market correction, culminating in the Great Depression. Fast forward to the late 90s, the dot-com bubble was another clear example. The tech sector was blossoming, with investors throwing money at anything that ended with .com. The bullish sentiment was overwhelming. However, by the year 2000, the bubble burst, leading to a major market correction. More recently, the global financial crisis of 2008 was preceded by a housing market boom. The bullish sentiment in the housing market led to risky lending practices, which eventually collapsed, leading to a severe market correction. In each of these instances, the euphoria of a bullish market blinded many to the inherent risks, leading to overvaluation and eventually a market correction. This is not to say that every period of bullishness will lead to a correction. However, prolonged bullishness, especially when accompanied by overvaluation and speculation, has often been a precursor to a market correction. And yes, markets do recover, they always have. But the corrections can be painful, and they can last longer than the bullish periods that precede them. It's important to remember that while markets are inherently cyclical, the timing and magnitude of these cycles are not always predictable. So, what does this tell us about our current market? Well, it's been a bullish run for quite some time now. Could a correction be on the horizon? That's a question no one can answer with certainty, but what we do know is this: understanding the past can help us navigate the future. As we can see, history often repeats itself in the financial markets. There are several economic indicators that suggest a market correction could be on the horizon. Let's start with inflation. Inflation is the rate at which the general level of prices for goods and services is rising. When inflation is high, it erodes the purchasing power of money. This can lead to a decrease in corporate profits, causing stock prices to fall and signaling a potential market correction. Next, we have employment data. High employment is a positive sign for the economy. More people working means more income, which can lead to increased consumer spending, fueling economic growth. However, if unemployment rates start to rise, this could mean companies are laying off workers due to declining profits, another indicator of a potential market correction. We also look at gross domestic product, or GDP growth. GDP measures the total value of goods produced and services provided in a country during a certain period. When GDP growth slows down, it means the economy is not expanding at its typical rate. This slowdown could lead to a decrease in corporate earnings, resulting in lower stock prices and signaling a potential market correction. Another key indicator is consumer sentiment. This measures how optimistic consumers are about the overall state of the economy. When consumer sentiment is high, people are more likely to spend money, driving up corporate profits and stock prices. But if consumer sentiment starts to decline, it could mean people are worried about the economy and may cut back on spending, another potential sign of a market correction. Lastly, we have the yield curve. The yield curve plots the interest rates of bonds with equal credit quality, but differing maturity dates. In a healthy economy, long-term bonds have higher yields than short-term bonds. But if the yield curve inverts, meaning short-term rates are higher than long-term rates, it's often seen as a warning sign of a potential recession and a market correction. These indicators give us a clear signal that a market correction may be inevitable. While a market correction may seem daunting, it's important to remember that it's a natural part of the market cycle. It's akin to the ebb and flow of the ocean tides, inevitable and predictable. Let's take a quick recap. We've looked at what a market correction is, a decline of 10% or more from the market's most recent high. We've delved into the current market scenario, highlighting signs that suggest we could be on the brink of a correction. We've also talked about historical precedents, demonstrating that market corrections, while potentially unsettling, are not only normal but expected. And lastly, we've discussed economic indicators that often signal an impending correction. Now, what does all this mean for you? Well, it's certainly not a cause for panic. Rather, it's a call to action. Market corrections, while they may temporarily decrease the value of your investments, can also present opportunities to buy quality stocks at discounted prices. It's like a clearance sale at your favorite store, but for investments. And while we cannot predict with absolute certainty when a market correction will occur, we can prepare for it. That's where financial education comes in. By understanding how the market works, you can make informed decisions that protect your assets and potentially even increase your wealth during a market downturn. Remember, the key to navigating a market correction is patience, preparation, and perspective. Don't let short-term market fluctuations sway you from your long-term investment goals. Instead, view them as opportunities to learn, grow, and invest wisely. So as we wrap up, let's turn our apprehensions into actions. Stay informed, stay prepared, and most importantly, stay financially savvy. If you found this content useful, do subscribe to Cashflow Positive for more interesting facts on finance and give this video a thumbs up. It really helps the channel. Until next time, stay financially savvy and cashflow positive.